How can an insurance company earning 5%, let's say, on their investments afford to pay you 8% on your IUL policy and then allow you to take out 10% a year, 10% payouts without depleting your principal? So by the end of this video episode, you will understand how it's possible for a company or for you to generate tax-free income, annual payouts, let's say during retirement, of $100,000 a year out of $1 million nest egg cash value in an IUL policy as long as you live, even if you live to be 120. So I'm Doug Andrew, and I've been teaching educational seminars. I've had my own radio show. I've written 12 books so far in my career, and I've been helping people optimize assets and minimize taxes now for north of 48 years. If you've watched very many of my educational videos or read any of my books, I'm very passionate about asset optimization and tax minimization and empowering what I call your authentic wealth. When people talk about their money, that's just one of a three-legged stool, one of three dimensions. But it's the financial dimension. And so this particular episode is addressing a question that I usually pose to my audiences at the beginning of a 4-hour seminar or a 6-hour Retire by Design event or even a 2-day clarity retreat. And I have done this thousands of times because I'm teaching them about one of my favorite vehicles, max-funded IUL, Indexed Universal Life, and why it's one of my favorite instruments for all kinds of financial goals. I call it the financial Swiss Army knife, the dream solution, whether you're saving money for retirement, college funding, for your kids and grandkids, or working capital for your business or real estate management, maybe an emergency fund, maybe estate planning. Maybe you're a school teacher retiring. You want to maximize the amount of pension benefits that you leave behind if you happen to die or whatever. It could be general tax reduction, strategic rollouts out of IRAs and 401ks, whatever. When you structure an IUL policy, it is the dream solution. Why? Because when you do it correctly and you fund it properly, it allows you to accumulate your money totally tax-free. Then you can access your money totally tax-free. Anytime without triggering tax if you do it the smart way. And at the end of the day, when you finally die, whether you die in an accident tomorrow or you die when you're 120 years old, whatever you leave behind blossoms. It increases in value and transfers income tax-free. Now, nothing else that I'm aware of does that in the Internal Revenue Code. Watch the episodes that explain that if you don't understand. It's section 72E, 7702, and 101A. That allows you to accumulate, access, and transfer money tax-free in a max-funded insurance policy. Now, I use Indexed Universal Life because that allows me to participate when the market goes up and not lose when the market goes down. Now, you also have to comply with 3 tax citations. They're called TEFRA, DEFRA, and TAMRA. And if you adhere to those tax citations, you are allowed to accumulate the money tax-free, but most importantly, you can access your money the smart way and generate tax-free income. So let's come back to this question that I would pose to my audiences at the beginning of a 6-hour Retire by Design event. They're coming to learn how to prepare to retire and maybe get their money out of those IRAs and 401ks and maybe sell some of their real estate, and they don't know where to put the money and they don't want to be a landlord anymore or whatever. They're wanting to optimize their assets, reposition underperforming, non-performing assets, convert to tax-free, always outpace inflation, and be immune from market volatility. That's why people set up IUL policies, which is very smart. And so at the beginning, I'll usually pose the question. Very few people will actually ask this question, even though there's been a handful. I'll say by the end of this event, you will understand how an insurance company earning, let's say, 4 or 5% on their investments, that's called their general account portfolio. If that's what the insurance company's earning, you will understand how they can afford to pay you, let's say, 8% or even higher some years, even though they're only earning 5%. They go, really? Yes, because a lot of advisors don't understand this. But one step further, you'll also understand how they can afford to give you a 10% payout. Let's say you have $1 million in your IUL policy. They will be able to give you $100,000 a year in income tax-free. That's 10% payout, without depleting your principal of $1 million, even if you're only earning or being credited 8%. And people go, what? How can they afford to give you 10% in a payout, $100,000, if you're only earning 8%, $80,000? And I go, you'll know the answer at the end of this event. So I'm going to cut to the chase and give you a sneak preview, okay? Simply put, an insurance company, they manage billions and some even trillions of dollars. One company I have my money in manages $3.5 trillion. That's as much money as the IRS collects in income taxes in an entire year, one insurance company. So they take these billions or trillions of dollars and they invest it in very conservative liquid investments. This is called their general account portfolio. And so they'll put a lot of it into AAA and AA bonds because they can sell those bonds, they're very liquid. They might loan money on skyscrapers and shopping malls, but they only loan 50% loan to value. They don't loan 80% of the value of the skyscraper like banks do, because if they ever have to foreclose, they want to come out and make sure they get their money back. And so they only loan 50, 60% loan to value. So if they ever have to foreclose on a shopping center, they come out smelling like a rose. This is why many banks and credit unions will take your money that you put in their bank, and they'll take 30 to 40% of their tier 1 assets for liquidity and safety, and they'll put it into insurance companies, and they increase the safety by maybe 5 or 6 notches higher, AAA instead of BBB, which is what a lot of banks are rated, and they increase the rate of return from where the bank pays you 1%, they turn around and make 4% by putting it into an insurance company. How much more is 4 than 1? Don't say it's 3% more. No, it's 4 times. It's 400%. On every million, they only have to pay a $10,000 in interest to their depositors at the bank. They turn around and make $40,000, 4 times, 400% more than they're paying you. If you don't understand this, you can bypass the middleman. So that's called the general account portfolio. So the insurance company, let's say, back in 1980 to 1990, on their general account portfolio, mortgage rates were like 18, 21%. CDs at banks were paying 10. On my policies, I never earned less than 11 3/4. I earned as high as 15.5. And that was their general account portfolio rate. But in the 1990s, interest rates started coming down, and so index universal life was introduced in 1997, so you could still outpace inflation. So if you've watched some episodes, what you're doing when you link to an index, any year that you feel bullish about America, you tell the insurance company, oh, you're earning 4%. If you think we're headed for a recession, you can just settle for the 4%. Now, they may take one of those percentage points for their profits and only give you 3%, which is still 3 times what banks are paying. That's called the general account portfolio rate, the fixed rate. Anytime you want to link to an index, you say, why don't you take that 4% interest on my million? In this example, that'd be 40,000. Now, I'm using $1 million example. You can extrapolate. It doesn't matter if you have 10,000, 100,000, 10 million in your policy, okay? So in this example, on $1 million, you're saying you don't need to pay me that 4%. You can take that 4% interest on my million, 40,000, and do whatever you need to do with it to have the wherewithal to pay me whatever the index does. So they buy upside options in the index or indices that I chose. There's episodes that explain this. And so if it's the S&P 500 or the Dow Jones or the Russell 2000, I can diversify. They buy upside options. Then if the S&P goes up 8, they can pay me 8% or 80,000. If it goes up 12, they pay me 120,000 on my million. They may have to cap me, but the floor is, if the market crashes, I don't lose 1 dime of my million. It's still safe in the insurance company. I simply didn't earn anything, but I didn't lose. So that's indexing. So 0 becomes your hero during the down years when other people might lose 30 or 40%. So far, so good. So based on averages, based on actual historical performance, an insurance company earning 4, when you link to an index, if you did it year in and year out, and you didn't even switch back and forth, you would probably earn 7 to 8%. So right there, an insurance company can afford to pay you 8%, even though they're only earning 4% on their general account portfolio. Because you're saying, you don't have to keep the 4% that you're earning for me. You can use that to buy upside options. They go, you mean we only have to pay you if the market goes up? We don't owe you a dime if the market goes down. We can just buy options and they expire worthless? Yeah. Why would you do that? Because 70% of the time the market will be up. When Indexed Universal Life came out, my average rate of return went from about 8% up to 9.6% and even 10.07 and 11.17%. By doing that, but let's just be conservative. The insurance company's earning 4, but they can afford to pay you 8 because you're allowing them to take that interest, that 4%, and buy upside options, and that gives them the wherewithal to pay you 8, even though they're only earning 4 because you let them buy upside options. And the years the market crashes, the options expire worthless, but you will average probably 2 or 3% higher interest by doing that. So far, so good. So now you know the answer. How can an insurance company earning 4 afford to pay you 8? Now, before I give you the last little tidbit, if this is intriguing you, be sure and share, post a comment, click like, but stay with me here to the end. I'm going to blow you away. So how can the insurance company afford to allow you to take out 10%? So you have $1 million and you're retiring, and you want to retire, and if you're earning 8%, yeah, you could pull out $80,000 a year without depleting your million, but most savvy people, they pull out 10% the smart way. If you watch other episodes, the smart way to access money is with index loans. So instead of just, taking out your 8% interest, you borrow money from your policy, and you can actually borrow, let's say, $100,000 a year out of your policy. And even if the policy is only earning 8, if you borrow $100,000, the insurance company may charge you 4%. You don't have to write out a check for that. They just deduct it out of whatever the index is earning. So if they charge you 4%, but you're earning 8, how much more is 8 than 4? Don't say 4. It's 100% more. So by borrowing money out, $100,000 a year, you're not only able to earn 8% on $1 million and then $1,100,000, $1,200,000 because you keep earning interest as it compounds. They're only charging you 4. That spread in that example is 4% spread. If you only averaged a 2-point spread between what they're charging you to borrow the equivalent of your interest and what they're crediting you, that allows you to take out 10%, $100,000 a year without depleting principal. If you're going, what? I just explained, and you can learn by reading my book and meeting with an advisor and see an actual illustration. We have clients that for every $1 million in their IUL policies, they can turn on income, let's say, of $100,000 a year. A 10% payout is what it's called. And year after year, their $1 million stays stable and even grows. We have one client that has $8 million. They've been pulling out 10%, and the $8 million is growing even though they're pulling out 10%. Because they've been pulling out money at 4%, and they keep earning 8 and 12 and 16%. But I'm just trying to be conservative. So the answer to the question, how can an insurance company that's only earning 4 or 5% afford to pay you 8? Because you're letting them take that interest on your money and buy upside options, and 70% of the time you're going to make more than that. And so you will average out maybe earning 7 or 8 or 9% or higher, even though they're only earning 4% on their general account portfolio. And then if you take it out the smart way, you borrow at, let's say, an index rate of 4, and they keep crediting you 6, 8, 10, 12, 15, even some years 61%, you can actually pull out 10% a year and not deplete your $1 million nest egg, even though the insurance company is technically maybe only averaging 8. In fact, if I say that to most advisors, they go, that's impossible. No, it isn't. We can show you thousands of clients' portfolios that they are getting 10% payouts without depleting principal by understanding this. So don't be left in the dust. My admonition to you is twofold. Number one, watch episodes here to understand this more thoroughly. Share them. And if you have not claimed your copy of this best-selling book, The Laser Fund, make sure you do by going to laserfund.com. Click on the link below. You contribute a nominal amount toward the shipping and handling. I cover the rest of that, and I pay for the book. There's options there to listen and learn, watch and learn. But when you're in there, there's a choice to be able to meet with an IUL specialist over Zoom or in person, whatever you prefer. And you can see how these strategies apply to your particular set of circumstances. But I would ask this favor. Before you do that, and you read and study and you watch these episodes, because it's going to be valuable time, to have the highest and best use of your time, here's what I recommend. Take time to learn. Know the answers to some of the basics, TEFRA, DIFRA, TAMRA, why is it tax-free, what's indexing, and so forth. Then when you talk to an advisor, if they're qualified, and I can point you to the ones who understand this, who have passed proficiency exams with 150 questions, okay, the conversation will start up here with your numbers instead of starting out clear down here with you asking questions like, so why is this tax-free? You ought to know the answer to that, and I'm passionate about educating you. But if you get educated before you meet with an IUL specialist, now you'll see how it applies to your set of circumstances. We can talk about your numbers right off the bat instead of 2 or 3 appointments down the road. Does that make sense? So here is to your brighter future. I want to see you on the other side of success.